So in this chapter, we'll be talking about trading stock, which the relevant legislation section is Section 70-5 of the Income Tax Act 1997. Now, what is trading stock? Now, think about from the perspective of a business. A business is going to hold things like inventory. So it might be a veterinary. They'll hold things like medicine and over-the-counter dog food and things like that. For us, a more complicated example of trading stock is actually a property developer. Now, most people would think a property that you're actually holding is a capital asset and not trading stock. However, if you're actually in the business of developing or selling properties, a building can actually be considered trading stock. So that's one of the most difficult concepts to get your head around is what exactly is trading stock? Well, if it's anything that you're holding or make or manufacture or acquire for the purposes of manufacture, sale, or exchange in the ordinary course of business. So this is the key word here. You must be carrying on something. You must be carrying on a business. And if you are in that industry and an asset you are holding on your balance sheet is for the purpose of doing something with that business, then it is trading stock. Now, I used the example of the developer before. So a property for the purpose of one person, say an individual investor, isn't trading stock. That's an asset. But if it's held by a developer, that is trading stock. So that's probably the key distinguisher of understanding what is trading stock and what isn't trading stock. So you probably remember this accounting equation from accounting 1B, which is just sales minus opening stock in brackets plus purchases minus closing stock equals your gross income, right? So your cost of goods sold is basically the movement in your opening and closing stock plus your purchases. So that's the accounting definition. However, for tax, it's a little bit different. The way you calculate it is you add the excess of closing stock over opening stock, or less excess of opening stock over closing stock, less purchases deduction equals taxable income. Right, so here are some very specific concepts around trading stock. So some specific examples. So computer software. So if it's actually developed for sale, it's trading stock. If it's developed for license, then it's capital. So this is another example of how in a unique example where one thing in the hands of one person can be trading stock and in the other it's not. So it's similar to the property example. So containers, label, and packaging materials. So if it's part of a product being sold, then it is trading stock. If it's just items sitting around for the purpose of packaging it, it wouldn't be trading stock. It would just either be expensed if it's a low value item, or it would be capital if it's a high value item. So crops, plants, if no longer growing, then it's a trading stock item. So land, we talked about this before, and this is the case that you would want to refer to if you ever do need to bring it up. It really depends on the purposes of who's using it, who's holding it, and if they're carrying on a business for that purpose. Otherwise, it's capital. So livestock, so when it's used in the primary production business, so a farmer, it is trading stock. But again, if you're just an investor who's bought a farm, or perhaps a residential investor, a resident who's just got livestock on their farm, then it's not trading stock. So again, similar for shares. So if you're holding it and your purpose is to be a professional share trader, then it can be argued that the shares are actually trading stock, not on capital account. So what's capital account and what's trading stock? So there are implications for how you account for it for tax purposes. So obviously, if it's on capital account, you're going to have to calculate your capital gains on it. So if it goes up in value, you'd have to, and you sell it, you have to take the difference between your selling price and the cost base, and the difference is capital gain. And obviously, there's different tax implications with that, from small business CGT exemptions to individual CGT exemptions to having a capital loss, etc. Trading stock, on the other hand, which we'll get to a little bit later, is actually goes through the income statement and is actually assessed as part of your assessable income. So we'll get to how that's accounted for shortly, but there are I guess the key thing to remember is there are different tax implications for each. So the first thing we need to know is purchases of trading stock are deductible. What does that mean? So if you were to purchase shares on capital account, so you're not a share trader, you don't get a deduction for acquiring it. It just forms part of your cost base and it will reduce your capital gain down the track. However, for trading stock, you actually get a deduction for the trading stock you've acquired, and that's under section 8-1. Now, there are some conditions. The stock needs to be on hand, i.e. when the taxpayer has the power to dispose of it. That's called dispositive power. So basically, if the goods are on their way, if they're in a shipment, you don't have the power to get rid of it. If it's in your store and you can actually sell it or destroy it or give it away, then you have dispositive power, and that's when it means it's on hand. Therefore, it's deductible at that point. If the risk is held with the taxpayer, so for example, depending on the terms of the shipment, if the shipment says you are responsible for the goods, then you can claim a deduction for it. However, if the goods are shipped and the shipper, the person sending the goods, is responsible for the state of the goods, the purchaser cannot claim a deduction at that point. It's only when they actually receive the goods in front of them. So consignment stock is not on hand unless it's cars on a floor plan arrangement by a car dealer. So for example, manufacturers often give away stock because it's quite competitive on their side. They'll give stock to sellers and they don't actually charge them for the cost of purchasing the stock until they've actually sold it. So they retain ownership of the stock right until the last minute. In this case, the stock is not on hand and the purchaser cannot claim a deduction for it until they've actually sold the goods and they've actually transferred ownership at that stage. So here are some non-arm's length transactions. So what does this mean? It means when you're selling trading stock for an amount that is well below or above what is market value for the goods. For example, if I am operating a clothes store or a luxury watch store, for example, I've got $2,000 Rolexes and I sell it to you, my friend, for $1. This is what happens. So if the amount paid for stock is greater than market value, for example, I've got some clothes and I'm going to sell it to a related entity for $2,000. So my other entity, which is a related party, can get a larger deduction. This is what happens. So the arm's length price, i.e. the market value, is deductible. So the purchaser wouldn't be able to claim the $2,000 or so for the good as a deduction. They'd only be able to claim the market value. So that's section 70-20. Similarly, the seller of the trading stock would only be assessable for the arm's length price. So they would reduce their assessable income in their sales. However, if market value is greater than the amount paid, there is no uplift to the market value for both buyer and seller. So what does this mean? This means if you're selling something for $1 and the market value is worth $2,000, it means the seller only records $1 of sales and the purchaser only gets a $1 deduction. So there's actually no uplift. It's an interesting one. I guess in the ATOs, kind of all works out in the end because they're getting 30% of that $1 and they're giving away a 30% deduction on the other side. So that's section 70-20. That's an interesting one. So disposals of trading stock are assessable income. So what does this mean? It means you're giving away damaged stock. You have to actually record that in your assessable income. So this is a tricky one, which you can often get caught out in exam questions. Just remember that. So prepayments of trading stock are not deductible until disposed of. Okay, right. So the other thing that we need to remember, and this is the trick with these trading stock questions, is often there's three or more different kinds of assessable incomes and deductions we must include. So this is the third and most common type, is at the end of the year we actually have to record the difference between the closing and opening and record it as assessable income in the P&L, or if trading stock value is lower than the value of the opening stock at the beginning of the year, then you actually get the deduction for it. Why is that? It's because it's assuming, in this case, that you've actually used up stock during the year and therefore you would get a deduction for that. to represent the usage of stock throughout the year, which is a genuine expense. Okay, so just remember that one. That's section 70-35. Okay, so let's move on to the valuation of trading stock. So how do we value trading stock? And this is under section 70-45. So at the during each period, the taxpayer must actually make an election as to how they're going to value the trading stock. There's three ways. One is cost, and often comes up with this lowest value. So it's basically how much you're paying for it on the invoice. You have to include delivery and any other cost to get those goods on hand with you as well. The second method is market value, and this is basically just saying what is the value of the goods if we were to sell it in an active market. And the third one is replacement cost, i.e. what would be the cost to actually replace this should it go missing or damaged, etc. Now keep in mind, determining on which valuation method you choose is going to have an implication for whether you get an assessable income or a deduction. And this is also a common question, especially in the online quizzes, because you'll get a question something like, how should taxpayer value their trading stock to reduce their taxable income? So that's a common question. So what you would want to do in that case is you'd actually want to minimize the closing value of your trading stock compared to your opening. So what this would do is it will allow you a larger deduction and therefore reduce your assessable income. So what you want to do is you choose cost, which results in the lowest value often, then market value. So this is a common one to remember. Okay, so let's move on here. So methods can change each year, but opening trading stock must equal to the prior period's closing stock, section 70-40. Hence why we keep on getting this question in online quizzes. So what would be the appropriate method to minimize their taxable income? You choose cost mostly, but they'll give you different values and you have to work out which one's the lowest. Okay, so what else can we go? Okay, so disposal of trading stock. So we mentioned before that if you dispose of trading stock, you have to include that in your assessable income. So there are many different ways you can dispose of trading stock. You can actually sell it, which is the most common way, and then you'd have to include it in your assessable income by way of sales, right? That's pretty straightforward. That's section 6-5. Now, there are other ways you can dispose of stock. One way is compensation. For example, you might have had a fire and it destroyed your inventory. Any compensation you receive for that needs to be included in your assessable income, section 70-115. Now here's a bit of a unique one, but it does come up in exams every now and then as a 1 or 2 marker. Trading stock used for private use. So you might get a question about a deli worker who uses a bit of ham. Every now and then they might take a kilo of ham each day and it adds up to $1,000 a year. You'll have to include that usage as assessable income in the P&L. And here's just a little note in our tax notes to remember to check if FBT triggered or deductible under allowance. So just remember that when we get to the FBT section. So here's another one about trading stock disposed of outside of the ordinary course of business. So what is the ordinary course of business? If you're a deli worker and you're selling meats, that's the ordinary course of business. Outside of that is any other way you've disposed of it, whether you are just writing off your stock, you're giving it away, or perhaps you are selling it or giving it to charity or anything like that. This is all outside the course of business, but you're disposing of it under this. This is section 70-9. The taxpayer is required to bring the market value of the stock as assessable income. So if you were to give that stock away, you'd have to record the market value of the stock as assessable income. So that can be quite a high value amount. So we would generally avoid doing this outside of the ordinary course of business. Okay, so deductible stock gifts to a deductible gift recipient are deductible at market value. However, on the other side, you must include the assessable income and deduction both at market value. So the net impact of that charitable donation is actually nil because you're getting a deduction for giving away the stock, but you're including it in your assessable income. So there's no tax implication for that, basically. However, what will happen is at the end of the year, you'll get a deduction for the stock usage once you use this up here, where the value of trading stock is less than the value of. So you'll actually get a deduction there. So it actually ends up being positive at the end of the year. So you actually get a benefit from doing that. Something to remember there. Okay, so change in ownership of trading stock. So this is common when you've got a partnership or a sale event. And once we get to partnerships, you realize that every time you form a partnership, there's a disposal of all assets, including trading stock. So the rule around this one is that change in ownership of trading stock equals notional disposal of stock at market value. So you basically need to include that stock in your assessable income at market value. Here's a reference to partnership that I mentioned just before. And here's a note about CGT is disregarded. Why is CGT disregarded? Because we're talking about trading stock. Trading stock is a completely different account to the capital account, which CGT falls under. Anything under trading stock comes under the P&L and assessable income. Okay, and the last thing we're going to talk about with trading stock is becoming or ceasing to be trading stock. So here's an example for you. I used the example of the developer before. Now let's say developer, all of a sudden he decides that in the ordinary course of business, he is not going to be a developer anymore. He's just going to be, an individual investor. So he's not going to carry on a business anymore of developing properties. He's given that up, but he still owns the property. So what happens then? The property goes from being trading stock to become a capital asset. Or it could be vice versa, where you are an individual investor and all of a sudden you decide you're going to develop property and that's going to be your business. You're going to do that regularly, etc. Now, the property is going to become trading stock. It's going to move from a capital asset to trading stock. So this is the tax implications of when assets change their account from capital to trading stock. Okay, so what happens when it goes from capital asset to trading stock? There is a deemed disposal and reacquisition by the taxpayer, section 70-30. Now, per this section, the taxpayer can elect whether this will be at market value or cost. If cost is chosen, there are no tax consequences. However, if market value is chosen, the CGT event K4 is triggered on the notional disposal. Right, so what happens? So let's say we've got a capital asset and we've chosen this becoming trading stock. So basically what happens is a deemed disposal. So that's going to trigger a capital gains event because you are disposing of the good, right? So let's say we're choosing cost. So what happens then? How we calculate a capital gain is it's going to be the consideration less the cost. However, what this is saying is if cost is chosen, the consideration equals the cost. So basically there's no capital gains event. That's what that's saying. However, if market value is chosen, then it's the standard capital gains event. So you got your market value, which is your consideration for the disposal, less your cost base equals your capital gain. So the taxpayer is going to have to actually include a capital gain in their tax return on the disposal. Right, and this depends on your situation. For example, you might have a lot of capital losses that you might want to offset, so it can be advantageous to actually trigger the capital gain then and there. If not, if you've chosen cost, all that means is the value of that trading stock, which is going to be lower almost in every scenario, you're probably going to have to, let's say we bought at 100 and the market value is 200. What's going to happen now is that this is now going to be the value of your trading stock. Okay, so cease to be trading stock. And what's going to happen is once you have to actually sell it or revalue it at the end of the year, the market value 200, you're actually going to have to include that difference in your assessable income once we calculate the difference between the opening value and the closing value of your stock on hand. Now, what happens if it ceases to be trading stock? It says it's a deemed disposal and immediate acquisition. So again, similar thing with the trading stock. It's going to go from trading stock. So we're going to sell all our trading stock. So you're going to have to include that in your assessable income, and also at the end of the year, you're going to get a deduction between the closing balance and the opening balance. Because the closing balance is going to be zero, you're going to get a deduction for that usage as well. So it should offset effectively. And so saying no market value election is allowed, so you must do it at cost. So that's pretty much it for trading stock. Not too difficult, pretty interesting, but there are a few tricks in there. Let's move on to the next chapter, which is GST.